All right, welcome back. Welcome back. We're going to jump into some interesting things here, taking a little dive into Ondo. Ondo, who might you be? So we had looked at this before. We're not going to go through that again. Ondo, institutional grade finance. I suspect this is all under the hands of BlackRock here. BlackRock. Yep, BlackRock. Goldman Sachs and BlackRock. So, yep. We went over to Flux Markets, which is where Ondo operates, right? Through this connect your wallet feature here. You can lend out by connecting your wallet, right? So from what I see, you can lend out these assets if you have them, right? Which I think is pretty cool because it says here, if you lend out, you get a 4.97% return on the money you lend. And it says here, when you connect your wallet, you've supplied this to their, I think a better word for this would be their bank. I feel like Flux is a bank that you connect to because you can be a part of the bank by lending your wealth and your value and getting a return on it. Hence, BlackRock, interesting indeed, I feel. Interesting indeed, right? And I'm trying to figure all this out, but we're going to get to it. Of course, we're going to get to it, but I just feel like, BlackRock, bank, lend, and borrow. Hey, connect your wallet if you want to borrow stablecoin. Now, we've been talking about stablecoins this week. What are we talking about here? USDC, stablecoin, USDT, Tether, stablecoin, DAI, stablecoin, Frax, stablecoin. Hey, you can connect your wallet to Flux, our bank. Ooh, BlackRock. I'm saying you can connect and you can borrow. If you borrow, you've got to pay us back what? I'm guessing. I don't know. This is an assets APY. I'm assuming. I could be wrong, but I'm assuming that you're going to pay them back at a 5.32% return, right? You're going to pay them that much back is what I'm assuming. I don't know. I think I could be wrong. But here it shows when you connect your wallet how much you borrowed. Interesting, right? How much is going to show right here? How much you borrowed. Then if we click on this markets button, it tells us that there is a total supply balance of $73.57 million. And they can loan out 32.9 million worth of it. Here we go. If you borrow USDC, which has a pool of 9.68 million, you will be paying back 5.32% interest. I'm assuming, right? You're going to pay that back at 5.32%. And they can loan out of that 9.68 million, 9.5 million, right? That's how much they can loan out. Look at USD. See, the supply APY is 4.97%. I guess, I don't even know really what that means without going to look that up exactly to see what that means. But so I was like, interesting, right? This is looking like a bank, right? Borrow and lending money through Flux, who seems to be running controlled by BlackRock. So it's like, all right, well, let's dig around. All right, so as I dug around looking, and I'll show you what I did. We're going to go to the bottom and show you exactly what I did. I started going through these, right? We're going to look at this one. This one didn't really explain much. I was like, this one's explaining more, and then we're going to go look at that, right? So let's go look at these things. Global digital assets beyond crypto tokenization. Analyst's name, Alkesh Shah. Analyst name, Andrew Moss, right? BO Bank of America Securities does and seeks to do business with issuers covered in its research reports. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this report. Investors should consider this report as only a single factor in making their investment decision. Now, this is as of June 29th, 2023, and doesn't mean that it still holds the same weight. It could be changed. It's from 2023. All right. So it says there are some key takeaways. Traditional asset tokenization may reach 16 trillion. Right? 16 trillion. Traditional asset tokenization. Transforming infrastructure and markets over the next 5 to 15 years. Now, this was put out in 23. Tokenization enables efficiencies, faster, cheaper, simpler, and catalyzes the new generation of SaaS companies. DLT/BCT is more than just crypto trading. Institutional and corporate use cases are in production. This was in 2023. They give us some things so we understand. DLT means distributed ledger. BCT means blockchain technology. EIB means European Investment Bank. FI means financial institution. LC means letter of credit. Meme coins are tokens with no utility or intrinsic value that are primarily used for speculative trading. NFT means a non-fungible token. Repo means repurchase agreement. SaaS means software as a service. TradeFi means traditional finance. And of course, DMV, I don't even know why they're going to be in this discussion. Department of Motor Vehicles. All right, so it says tokenization and infrastructure evolution. We are on the verge of an infrastructure evolution that may reshape how value is transferred, settled, and stored across every industry. Tokenization is just one DLT, distributed ledger technology of the blockchain technology application, but this one application may transform financial and non-financial infrastructure and public and private financial markets over the next 5 to 15 years. Disruptive innovations like the radio, television, and email took 30 years to reach mainstream adoption. We expect a far shorter road for digital assets, of course. Efficiencies and reduced costs for every industry. Financial institutions, did I get that right? Financial institutions are increasingly leveraging distributed ledger technology, smart contracts, and tokenization to enable 24/7 real-time or customizable settlement, reduce credit risk, lower settlement, financing, and operational costs, increase liquidity for previously liquid assets, and allocate capital more efficiently. Boom. Lending, borrowing, markets, capital. All right, let's go back. Allocate capital more efficiently. Corporates are leveraging the same technology to generate incremental revenues, automate manual processes, optimizing supply chains, increase customer loyalty, offset contributions to climate change, and combat counterfeiting. We accept DLT, distributed ledger technology implementation accelerate among financial institutions and corporations as the opportunity cost of uncaptured efficiencies increase. Okay, what are we talking about? We're talking about this banking system here, right? This is becoming more efficient. You will connect your wallet. Okay, you're going to connect your wallet here. You're going to borrow money. They're going to let you know how much you can borrow. This is how you're going to track everything through an app. You're going to use your wallet and track through an app or, however they do it. I don't know how they do this. I haven't tried it and I'm not going to use it because I don't need to borrow money. But it's interesting to see that this is what's happening. This is what they're doing. BlackRock, what are you doing? Right? Traditional finance and corporate adoption accelerates rapidly. Financial institutions and corporate tokenization use cases are diverse and expanding. Citi issued a tokenized LC is letter of credit. Letter of credit to decrease processing time from 3 to 3 hours from 5 to 10 days. Whoa. Traditionally, it would take 5 to 10 days to issue a line of credit. Was that line of credit? What was that? Letter of credit, right? letter of credit or a line of credit. I think it's really just letter of credit, line of credit, same thing. I personally think that's what it is, line of credit. 5 to 10 days, right, to approve that, get it done, and get that money moved. The EIB issued a tokenized 100 million, was that euro, I guess, bond with T plus zero settlement. KKR and Hamilton Lane tokenized private equity funds to reduce minimum investments to 10,000 to 100,000 from 5 million. Broadridge's direct ledger technology platform settles 1.4 trillion a month of tokenized repossessions. Nike generated 93 million plus in secondary non-fungible token sales by tokenizing royalty streams. Pharma companies are tokenizing supply chains to combat drug counterfeiting. That results in 1 million deaths a year. The California DMV tokenized vehicle titles to reduce issuance to minutes from weeks. Look at this here. Hey, come here. Somebody look at this. Somebody come here. Look at it. Come here. Look at this. Somebody look at this. Look at this. What? What did they do? Let me back this up for a second before we go any further. This is as of 2023. 2023, okay? Financial institutions and corporations' tokenized use cases are diverse and expanding. Citi, as in Citi Financial, issued a tokenized letter of credit or a line of credit, right? To decrease processing times, right? To 3 hours from 5 to 10 days. Okay. The European Investment Bank issued a tokenized 1 million euro bond with, it doesn't say, T plus zero settlement, transaction to zero settlement. I don't know. KKR and Hamilton Lane tokenized private equity funds to reduce minimal investments to 10,000, 100,000 from 5 million. Look at this. Now look at this. You can lend this bank Flux. I'm calling it a bank because it's acting like a bank. Look like a bank, quack like a bank, act like a bank, must be a bank, right? You can connect your wallet and lend money to this bank and borrow money from this bank, okay? Reduce minimum investments to 10,000 to 100,000 from 5 million, right? So you can invest and get a return if you invest your money at that bank over there, right? This is all distributed ledger tech, right? That's all we're talking about, distributed ledger technology. So anyways, the platform settles 1.4 trillion a month of tokenized repossessions. Okay, repos 1.4 trillion a month. Nike generates 93 million in secondary non-fungible token sales by tokenizing royalty streams. Pharmaceutical companies are tokenizing supply chains to combat drug counterfeiting that results in 1 million deaths a year. And the California DMV tokenized their vehicle titles, right? They tokenize them. That means they're non-fungible tokens, I would assume, right? I'm assuming, but I think that's what that means. To reduce issuance to minutes from weeks, which will then sit in your wallet. You can put that in your wallet. Right? That's crazy on blockchain because it's a token now. It'll be on your wallet, right? Like, oh, I got it. And then all they got to do is scan and they should be able to see the data, right? I don't know technically how that data works, but I do understand once it's tokenized, it's a currency. It's a token that now sits on your wallet, because, most wallets have the NFT, non-fungible token space slot where you can store those non-fungible tokens, right? So it says tokenized traditional assets aren't crypto. Blockchains are a type of distributed ledger that allow open access to network data, public and the network permissionless. Meme coins receive outsized attention, but blockchains require tokens to reward network participants for processing transactions and to secure the network by ensuring participants have skin in the game. In contrast, distributed ledgers facilitate regulated regulated financial institutions and corporations use cases by restricting access to network data or private and the network permissions. Distributed ledgers do not require tokens to reward network participants for processing transactions or to secure the network because participants already have skin in the game. It's their reputations. All right, so in the not too distant future, you may open up an iPhone app. Right? Look at all these apps. To check the market value of portfolio holdings, which we do now, which include tokenized dollars, right, which are stable coins, Apple AAPL stock, corporate bonds, which means they're going to put it all together in the future, right? Could be now. All is together. Interest in a private equity fund, carbon credits, really, royalty rights to Rihanna and Diplo songs, interest in a diversified blue chip art fund, and tokens that power blockchain operating systems. You may sell 47.62% of your private equity interest at 5:15 p.m. to 20 different buyers through a liquid secondary market. We expect tokenized assets to become so ubiquitous that token portfolios will simply be referred to as portfolios. Mind blowing. Let me take you back. That was in 2023. Okay, we're only talking about the Bank of America. This is the stuff that they were saying in 2023. Tokenization and transformation of global markets. Tokenization refers to the process of creating digital programmable representations of traditional finance and non-financial assets that can be exchanged and tracked on distributed ledgers or blockchains. We expect the tokenization of traditional assets to transform financial and non-financial infrastructure and public and private financial markets over the next 5 to 15 years. As we wrote in our primer, we are only in the first innings of a major change in infrastructure. Wait a minute. What are you saying? We are only in the first innings of a major change in infrastructure and applications that may reshape how value is transferred, settled, and stored. Who's saying that? Bank of America in 2023. Our view is that the tokenization of traditional assets and issuance of assets in tokenized form have the potential to increase efficiencies and reduce costs across an asset's life cycle, improve the efficient allocation of capital, optimize global supply chains, capitalize a new generation of software as a service companies, and ultimately drive mainstream adoption. Distributive innovations like the radio, television, and email took 30 years to reach mainstream adoption, but we expect a far shorter road for digital assets. I quote, "I actually believe this technology is going to be very important. I believe the next generation for markets, the next generation for securities, will be tokenization of securities." Larry Fink of BlackRock, Chairman and CEO. Wait, what? Larry Fink, BlackRock, Chairman and CEO. November 30th, 2022. What? What are you talking about? What are you talking? BlackRock. Okay, that's what we're talking about. Distributed ledger tokenization and tokenized traditional assets aren't crypto. It goes on to say, although some blockchains support the exchange and transfer of tokenized traditional assets, our view is that decentralization and lack of customization, data privacy, and permission access to the network limit current financial institution and corporate use cases that require expanded scalability and regulatory compliance. Yeah. Compliance, regulatory. But what's happening in 2025? We're going to have a whole cast of crypto, pro-crypto enforcement and employees in the government, right? So this is going down in 2025. Now hey man, this is from 2022, and this whole thing we're reading is from 2023. But we're in 2025, and this thing is set up with the right people to get all this in motion. Not to mention that Ondo is going to be dropping more currency, unlocking more of their currency, 1.9 million, I believe, coins. They're going to be unlocking those, right? And what are they for, right? What are they for? Institutional grade finance now on chain, right? What are we talking about? They're going to be using this stuff to run this stuff. What are we talking about? Blockchains are a type of distributed ledger that remove the need for some intermediaries, support trustless transactions, record network activity, and token ownership data transparently, and allow open access to join the network. Blockchains record ownership of the 26,000 tokens that exist within the digital asset ecosystem. But we expect 99% of those in existence today to essentially disappear. Go away over the next 10 years. We expect it. That's what's going to happen. No, in 2025, we got a whole new group of people coming in that are all about this system right here. They're all about this. They're coming in to make this happen. And this here, 99% of those in existence today will essentially disappear over the next 10 years. Meme coins like Shiba Inu and Pepe receive outsized attention despite having no utility or intrinsic value. But other tokens are different. Public permissionless blockchains like Bitcoin, Ethereum, and third-generation blockchains are decentralized and require tokens to reward network participants for processing transactions, but also to secure the network by requiring participants to have skin in the game. That disincentivizes malicious behavior. In contrast, distributed ledgers provide customizable infrastructure for financial institutions and corporations use cases that ensure regulatory compliance by restricting access to network activity and token ownership data, and preventing unknown entities from joining the network. Distributed ledgers still remove the need for some intermediaries, but also the need for tokens to reward network participants and secure the network. Network participants, which may be consortium of financial institutions or corporations, are centralized and don't require tokens to align incentives because they already have skin in the game, which is their reputation. Just as there was an explosion of simple to complex websites in the 1990s that altered how we shop and interact, in the coming years, we could see the tokenization and decentralization of many aspects of the economy. Distributed ledgers and blockchains provide back-end infrastructure, but some investors may underappreciate how this disruptive technology is powering an infrastructure evolution that may touch every industry. We believe the lack of user-friendly front-end interfaces and the disproportionate focus on Bitcoin, meme coins, regulatory headwinds, and illicit activity are overshadowing the rapid development of real-world use cases that are in active production today. Now let's stop right there for a second. Breathe. Bitcoin's in the way. Hey, Bitcoin, you in the way. You fooling everybody. You got people think it's all about Bitcoin, bro. We know you just a store of value. You prehistoric anyway. You prehistoric, bro. Meme coins? Oh, we know that's a farce. And now that artificial intelligence is doing it, we really know it's a farce. Like a farce fart. It's funny. So they're in the way, right? We all know it's about utility. It's all about a use case. And meme coins and Bitcoin, not really a use case. Bitcoin, it's a store of value. People hold value in it, so it increases the value, right? It is what it is. Meme coins, a total joke. It's a total joke. And you got to understand, it's a meme, right? Don't take it seriously. Don't go broke. Here's another quote. I was initially a crypto skeptic, but I think crypto is here to stay, and with proper oversight and regulation, it has the potential to greatly benefit society and grow the global economy. And this was Bill Ackman, Pershing Square Capital Management founder and CEO, also in 2022. We accept the tokenization of assets and funds within markets that are the least efficient and most intermediated to be tokenized first. And assets and funds within markets we accept the tokenization of assets and funds within markets that are the least efficient and most intermediated to be tokenized first. And assets and funds within markets where the reverse is true to be tokenized last. Consultants expect the value of tokenized assets to reach 10% of global GDP, which will be 16 trillion by 2030. However, our view is that forecasting the value of tokenized assets over the next 10 years may signal tokenization's disruption potential, but ultimately distracts from the largest transformation of infrastructure and markets in over 50 years. Efficiencies that distributed ledger technology enables and new products and applications that become economically viable. They know it's coming, like, bro, we in there. Here's a quote. The unified ledger thus opens the way for entirely new types of economic arrangements that are impossible today due to incentive and informational frictions. The eventual transformation of the financial system will be limited only by the imagination and ingenuity of developers that build on the system, much as the ecosystem of smartphone apps has far exceeded the expectations of the platform builders themselves. And this is from the BIS Blueprint for the Future Monetary Systems in 2023. Goes on to say institutional investors and banks are increasingly leveraging distributed ledger technology, self-executing contracts, tokenization, and fractionalization to enable customizable settlement times, reduce credit risk, lower settlement, financing, and operational costs, increase liquidity for previously illiquid assets, and more efficiently relocate funds previously held as collateral to yield-bearing assets or rebalance portfolios with illiquid assets. The distributed ledger technology may also facilitate increased retail accessibility to alternative assets, as well as the creation of improved financial assets and applications, some of which were not economically viable previously. So the issuer wants to get an asset, so they get a smart contract. The smart contract mints a tokenized asset. For the investor, goes to the smart contract, tokenized digital, layer 1 blockchain, tokenized digital asset, layer 2 scaling solutions, Oracle networks, layer 3 decentralized Web3 applications. Okay, so the technicalities or technicals of that, I don't understand it, but it's going to work. Whatever it is, it's going to work. Our view is that corporate distributed ledger technology and tokenization use cases are potentially more diverse and expansive than financial institution use cases. In fact, over half of Fortune 100 companies have launched projects leveraging the distributed ledger technology. Wait, what? Over half of Fortune 150? 50 since the beginning. Is it 50? It says 100 companies since the beginning of 2020. Since when? 2020. It's 2025. Since 2020. Corporations across every industry are increasingly leveraging the same underlying technology. Wait, what? 2020? Yes, they've all been doing this. As financial institutions to generate incremental revenues, lower costs by automating manual processes, optimize. Well, wait a minute. They're always, AI. We don't need humans to do these things anymore. Yeah, this stuff has been going on for years. And here we are in 2025. We're like, oh, it's going to change. No, it's been changed. They've been doing this. Look at this. Hey, man, you don't need to take my word for it. They've been doing it since 2020. Okay. This can optimize supply chains, broaden potential customer pools, increase customer loyalty, offset contributions to climate change, combat counterfeiting, and appeal to environmental, social, and governance-focused customers and investors. Many companies with the greatest risk of disruption or that fear a loss of market share are proactively exploring how to enter the digital asset ecosystem and leverage its many use cases. Tokenization is just one of the many distributed ledger technology applications, but we expect this one application to lead to new and more efficient primary and secondary markets for financial and non-financial products. There you go. In the not too distant future, institutional and retail investors may open an iPhone app to check the real-time market value for their portfolio holdings, which include dollars that have been tokenized, Apple stock, Cash App. Cash App, you can see the stock and you can see your Bitcoin. You can see any money you have in that app. Like, you can see all this on Cash App. Now, what I'm waiting to see is Cash App pick up those legal, non-taxable cryptocurrencies this year. I'm waiting to see that. When those, if you know what I'm talking about, what Trump said, if any of those that Trump talked about hit Cash App, okay? Because it's going to be stable dollars, right? And you're going to see stuff like this, right? You see how if you lend it, you see how, where is it at? Let me go here. Borrowing, supply, total. Does it show me? Well, maybe, you're going to see something similar to this, like your return for lending, right? You're going to see that. So I'm waiting to see that in Cash App. Okay. And everybody has Cash App. It's very simple. Right? Everybody has Cash App on their phone. If you don't know, you can get it. It's very simple. And I'm expecting to see, because on Cash App, you can buy stock. You can check what's going on with your stock right there on the app. You can buy Bitcoin. You can see what's going on with your Bitcoin. If you got any money sitting there, you can see what's going on with that. Right? You can move stuff in and out of your bank. I'm waiting to see this on Cash App. Okay. It says portfolio holdings may also include carbon credits, rights, and royalties generated from Rihanna, diversified blue chip, Ownership of these tokenized assets will be immutably recorded on one of the 5 to 15 distributed ledgers or blockchains that survive consolidation. Wait, what? They're going to consolidate, and it should be like 5 to 15 ledgers that exist when they consolidate. What do you mean? 99% of these cryptos gotta go. Why? Because they're meme coins. They're jokes. What? Hey man, don't take my word for it. Don't take my word. Some of which are public, full data transparency for transactions since inception and permissionless. Anyone can join the network, and some of which are private and permission within the same app. You may fractionalize and sell 47 of interest in a private equity. Okay, I could see a day in the not too distant future. Client's portfolio is not 10% to 15% alternatives, but 50%. Mark Rowan, Apollo CEO, May 5th. The more things change, the more they stay the same. The digitalization of financial assets began in 1971 when NASDAQ introduced infrastructure enabling the world's first electronic stock exchange. Okay, that was 1971. You guys, we are in the 2025 now. This stuff's been going on for years already, right? This is nothing new. Nothing new. It's going into effect this year as far as they're going to let the world know. We're coming out. We want the world to know this is what we've been doing. Crypto, let it show. That's what they've been doing. And that's why you heard that guy Trump tell you, oh yeah, the first thing I'm going to do is I'm going to make, if you're a cryptocurrency based in the United States, oh yeah, man, regulation's good for you. We're going to make it so that your currency isn't taxed. Right? That's crazy. But is it? However, 27% of settlement systems today still leverage legacy infrastructure that is over 20 years old. Today's financial systems continue to be built on centralized, company-owned, and fragmented infrastructure that requires third-party intermediaries, which limits efficiencies, interoperability, innovation, and functionality. Increases time to settlement and cost, and prevents the efficient allocation of capital. Okay? Well, how can you get capital? You can connect your wallet here and borrow, and then get capital. Isn't that interesting? Despite last year's digital asset market correction, financial institutions, central bank, and corporate interests remain an industry developed accelerated for private permission distributed ledgers and blockchains. Our view is the customizable distributed ledger blockchain subnetworks or subnets and smart contracts have reached maturity and production after years of development. In contrast to public permissionless blockchains, private permission distributed ledgers and blockchain subnets integrate separate systems into one and enable the efficiencies provided by distributed shared ledgers, but with enhanced functionality and reduced regulatory and reputational risk. We expect distributed ledger technology implementation to accelerate as the opportunity cost of uncaptured efficiencies and reduced costs increase. All right, what else do they have here? This is a lot. I can't go through all this, but I'm telling you, like, this is heavy. This is not a game, okay? Bank of America Global Research. They did the research, okay? All right, here, right? What do we have here? So following this one over, this one's Francesca Carapella, Grace Chuan, Jacob Gertson, Chelsea Hunter, Nathan Schwem. All right, it says, in this paper, we outline tokenization, which is a new and rapidly growing financial innovation in crypto asset markets, and we discuss potential benefits and financial stability implications. Tokenization refers to the process of constructing digital representation, crypto tokens for non-crypto assets. Reference assets, as we discussed below, tokenizations create interconnections between the digital asset ecosystem and the traditional financial system. At sufficient scale, tokenized assets could transmit volatility from crypto asset markets to the markets for the crypto tokens reference assets. Okay. So they have the PDF, which will take us here. And it says, the tokenization overview and financial stability implications. You can see there Grace Chuan, Jacob Gertson, Chelsea Hunter, Nathan Schwem, and Francesca Carapella. This is of August 3rd, 2023, the Federal Reserve Board of Governors. We just read that. All right, so we'll go through a little bit of this. We're not going through all 29 pages. No. The term tokenization refers to the process of linking reference assets to crypto tokens via design features that link the token's price to the value of the token's reference asset. Let me make this a little bit bigger. I want you all to get a view of that. Tokenization would allow for crypto token holder to have legally enforceable ownership claim over the token's reference asset. So far, tokenization projects have been typically financed and developed by small venture capital-backed crypto companies. In addition, financial firms such as Santander, JP Morgan, and Franklin Templeton have announced crypto-related projects or pilot programs related to tokenization. As is the case with stablecoins, tokenizations have widely varying design features and characteristics. In general, the tokenization involves 5 design features: a blockchain, a reference asset, a mechanism to assess the value of the reference asset, a means to store and or provide custody for the reference asset, and a mechanism to facilitate redemption of the token and or the reference asset. Taken together, these components generate links between the crypto markets and the markets for the reference asset. These design choices can help distinguish token types and help determine each type's impact on traditional financial markets. The first tokenization design element that we outline is the underlying blockchain on which the crypto tokens are issued, stored, and transacted. Some crypto tokens are issued on a private permissioned blockchain, and others are issued on public permissionless blockchains. A permissioned blockchain is generally controlled by a centralized entity that grants approval to selected users in an isolated ecosystem. Now, funny we should read this because I am in the belief, I could be wrong, but I am in the belief that Ripple has their private and public. And because they have a private and public, I believe here where it says an isolated ecosystem is separate from the ecosystem that we see on the market. So this, in my mind, makes me think that we don't see the full view of XRP, because it could be operating in a separate market, which is where the institutions would be, and we don't see it. I could be wrong. I'm speculating. I'm thinking about this. I'm really thinking about this because here, a permissioned blockchain is generally controlled by a centralized entity. We know who a centralized entity would be. We look at Ripple and we say, well, that's a centralized entity that grants approval to selected users. I could see that in an isolated ecosystem. All right, crypto tokens issued on permissionless blockchains, Bitcoin, Ethereum, Solana, etc., are broadly accessible and can be used with fewer restrictions. Crypto tokens on permissionless blockchains can also be incorporated into decentralized finance or DeFi protocols such as decentralized exchanges. Crypto token issuers retain far less control over crypto tokens issued on permissionless blockchains than do issuers of crypto tokens on permissioned blockchains. For example, of tokens issued on permissioned blockchains, another component of tokenization is the crypto token's reference asset. Reference assets can be categorized in various ways: off-chain versus on-chain, tangible versus intangible, etc. Off-chain reference assets can be physical, such as real estate and commodities, or intangible, intellectual property, rights, and traditional financial securities like stocks and bonds, and exist outside of the crypto asset ecosystem. Tokenization with physical off-chain reference assets generally involve an off-chain agent, such as a bank, to assess the value of the reference asset and provide custodial services. Tokenization that reference other on-chain crypto assets can incorporate smart contracts to provide custody and valuation assessments. The final design element of many tokenizations is a mechanism for redemption. Similar to certain stablecoins, tokenizations allow for crypto token holders to exchange crypto tokens with the token's issuer for the reference assets. A token redemption option can exist for both off and on-chain reference assets and generates a link between markets for the tokenized asset and markets for the reference asset. As we discuss in more detail below, also tokenized assets can be traded in secondary markets, such as centralized crypto exchanges and DeFi exchanges. Some tokenization that reference other on-chain debt or equity securities do not incorporate redemption mechanisms, but still confer ownership or other rights to the crypto token holder. In these cases, the tokenization process involves representing the legal claims over the cash flows associated with other on-chain financial assets or any other obligations of the entity issuing those financial assets. And we'll just read a little bit more before we close this out. The current size of tokenization markets and specific examples of tokenized assets. Using press release, news articles, and public data sources, we estimate that the market value of tokenized assets on permissionless blockchains is $2.15 billion as of May 2023. This includes a wide range of tokens issued by decentralized protocols such as Centrifuge and traditional companies such as Paxos Trust. A comprehensive set of time series data is difficult to obtain due to the wide variety of tokenization designs and varying levels of transparency. Therefore, we capture a subset of tokenization projects by utilizing open source data from DeFi Llama and Figures 1 and 2 to highlight the growing trend of tokenization in DeFi. Figure 1 shows the total value locked in the entire DeFi ecosystem has remained roughly constant since June 2022. However, in Figure 2, we show that the total value locked in categories related to real-world assets have grown since July 2021, both in absolute values and as a share of the overall DeFi ecosystem. Now, as of May 2023, roughly 700 million of our estimated 2.15 billion are locked in DeFi. Many new tokenization projects have been recently announced with reference many types of assets, including agricultural commodities, gold, other precious metals, real estate, and a variety of financial securities. In Table 2, we list examples of tokenizations to illustrate the range of reference assets. Specific examples of recently developed tokenized assets referencing agricultural commodities include soya, kora, and whey, which reference soybeans, corn, and wheat, respectively. These tokens were part of a pilot project launched in March 2022 in Argentina by a joint venture between Santander and the crypto firm AgroToken. The claims on the underlying commodities embedded in these tokens and the infrastructure to validate and process transactions and redemptions are designed to be sufficiently robust to allow for Santander to accept these tokens as collateral for loans, right? So you want a loan, give us some of your wheat tokens that can be redeemed for wheat. Look at that, right? Give us some soybean coins that can be redeemed for soybeans, right? All this over the blockchain. Santander and AgroToken stated that they hope to introduce similarly designed commodities tokens in the larger markets of Brazil and the US in the future. Other examples of non-financial reference assets are gold and real estate. The market capitalization of tokenized gold is roughly $1 billion as of May 2023. Two coins dominate 99% of the market, that is Pax Gold, PAXG, issued by Paxos Trust Company, the Tether Gold, XAUT, issued by TG Commodities Limited. Both issuers equate each of their coins to one fine troy ounce of gold that is custodied by the issuers themselves and meets the standards set by the London Bullion Market Associated. So, you can get gold that can be you can get their coins which are redeemable for the gold, and they hold the gold. All right, so you gotta, that's a trust system right there. You gotta trust that they got your gold, right? All right, let's continue. Redeem for USD at current gold prices, while XAUT. Well, you can't get the gold, you can only get the money. Can be redeemed for proceeds from Tether selling the underlying gold in the Swiss gold market on holders' behalf. Overall, these two designs are similar, resulting in similar prices. PAXG and XAUT that also closely follow the price of gold futures. Relative to commodities like agriculture and gold, reference assets like real estate are less uniform, with less liquid markets and values that are harder to assess and involve more complex legal and tax processes for ownership and transactions. These issues pose significant challenges for tokenizations. One example of a tokenized real estate project issuer is Real Token Incorporated, RealT, which collects an inventory of residential properties and tokenizes a variety of legal rights on them. Each property is owned by a limited liability company that is legally independent of Real Token Incorporated. The property itself is not directly tokenized, rather the membership interests in the LLC are tokenized. Therefore, each property corresponds to its own LLC whose membership can be fractionalized into shares for co-ownership. For example, tokenized properties by RealT are Real Token, 15634 Liberal Street, Detroit, Michigan, and Real Token 25097 Andover Drive, Dearborn, Michigan. Real tokens were primarily developed for international investors as a way to own domestic U.S. real estate and collect rental income. Look at that right there. This shit's been going on since 2022. Where the fuck have we been? Where have we been? Realty? Where they're collecting rental income. Bro, listen, this is coming quick. Okay, this has been in existence since 2022. This shit's going to take off like a rocket. You're going to be soon to use these apps, right, to get on there and pick up property, right? You're going to be a part ownership of a property. You're going to buy tokens of that, right? How many shares of that token do you have? You might have 50 shares of a 25,000 token share, right? And so that means you'll probably collect some form of income, right? So if the income that comes in, let's say this is a big problem. Let's say the income comes in as, I don't know, $25,000 a month or $50,000 a month or $100,000. I don't know what it costs a month. Whatever that is that comes in per month. Your 50 coins of it, right, might bring you $50 worth of it or something. I don't freaking know. I'm just throwing numbers out there. Either way, you will have the ability to collect some of that rental income, right? That's crazy, but is it really crazy though, bro? So this was as of September 2022. Realty tokenized 970 units of property valued at over $52 million. Finally, they are tokenizations referencing financial assets such as stocks, bonds, and exchange-traded funds, ETFs. Tokenized stocks provide token holders with similar economic exposure as holders of the reference stock. However, the prices of the tokenized stock and its reference stock may differ, partly due to the former being able to trade 24/7 and partly due to the token's intrinsic properties such as programmability and composability in various DeFi applications, which may also affect the token's liquidity. We illustrate these dynamics in figures 3, 4, and 5. Meta's corresponding crypto token, Bittrex FB, as well as each of their volumes. They are tokenized versions of existing stocks issued on traditional regulated exchanges. We already knew stocks were coming, but that's cool. And tokenized versions of stocks such as OSTK, Overstock.com Incorporated, that are entirely issued on a blockchain. The Swiss-based platform Aktionarit is an example of a firm that currently offers tokenization services of stocks for Swiss companies. U.S. companies such as Amazon, Tesla, and Apple each have tokenized stocks that are currently or have been previously traded on crypto exchanges such as Bittrex and FTX in early 2023, right? Ondo Finance launched OUSG, OSTB, and OHYG tokenized ETFs referencing BlackRock U.S. Treasuries. Wait a minute. Let's go over here and look. All right, markets. Well, there's one. OUSG, right there. $37.67 million dollars of total supply. Now, collateral factor, 92%. The price, $108. I guess for, what is that? One token? Is that what we're looking at? If you get one OUSG token, it's going to cost you $108.48. We know that this is a stable coin, so every one USDC is $1. So here, OUSG, you can get a share of that or one of those at $108.48. So what are you getting when you do that? What are you getting? What are you getting? Right? You're getting an ETF, right? BlackRock U.S. Treasuries ETF, PIMCO Enhanced Short Maturity Active ETF, and BlackRock, and this is Ondo Finance launched OUSG. So BlackRock iBox High Yield Corporate Bond ETF, respectively. These tokens represent deposits in the reference ETFs and quality as securities, but Ondo Finance also holds a small portion of USDC and USD in reserve for liquidity purposes. Ondo Finance is the manager of these funds, with Clear Street serving as prime broker and custodian of the securities, and Coinbase serving as custodian of the stablecoins. Well, we know that this is Ondo, And this is their app for the market. And here is OUSG, $108.48 per, right? Let's go back. Potential benefits, right? Tokenization has potential to provide a variety of benefits, including granting investors access to markets that are otherwise inaccessible or costly to enter. For example, real estate tokenization might allow for investment in a fraction of the underlying asset, with investors able to purchase shares in specific commercial buildings, or residential investments as opposed to real estate investment trusts, where investors own shares of a portfolio of real estate investment. More generally, the programmability of crypto tokens and the ability to leverage smart contracts allow for additional features that can be embedded into the tokenized asset, which might also benefit markets for the underlying reference assets. For example, liquidity saving mechanisms could be implemented in the settlement of the tokenized asset, even if they are not implementable for its real-world counterpart. These attributes might lower barriers to entry for a wider set of investors, resulting in more competitive and liquid markets and better price discovery. Tokenization might also facilitate lending through the use of tokens as collateral, as in the case of tokenized grain discussed above, where lending secured by the reference asset might be more costly or impossible. Moreover, transactions in the tokenized asset can settle more quickly than transactions in their respective real-world reference assets. Look, we ain't gonna go no further. This is crazy. This stuff is being tokenized. This is real. It's being tokenized. And to prove it, it's right there. OUSG, right? This is some ETF. This is ETF right here. They said it, not me. This is ETF. $108.48 per token, right? Well, we're only talking about an ETF. It's right there. That's it. All right, so just digging into Ondo Finance, like I said, there's probably a whole ton more to get into. But I don't even think we got to go any further. I think that's enough. You guys do the math on that. I'll catch you in the next one.